Welcome to this explainer. Today, I'm stepping in as your financial coach to help you build a concrete, automated wealth-building playbook. And we're tailoring this specifically for middle-class families earning between $50,000 and $100,000 in 2026. Look, if you've been feeling the squeeze lately, you are absolutely not alone. The financial advice industry loves to pretend everyone has unlimited bandwidth, They tell you to just magically save 20% of your income or max out every single account. But that assumes a level of financial slack that simply doesn't exist for most hardworking households today. So we're stripping away all those unrealistic expectations. We are focusing exclusively on what actually works for your budget.
Let's start by setting the scene with a stark, almost cinematic reality. High APR credit card debt is the absolute villain in your financial story. It's the invisible leak in your boat. When you're paying average credit card interest rates, which have been hovering right around that 24% mark, you are quite literally paying a premium just to survive. Every single month you wait to build financial security is a month where one unexpected bill can push you deeper into a cycle that drains your wealth before it even has a chance to compound.
Think about the sheer contrast between the chaotic stress of living paycheck to paycheck and the calm, structured reality of a well-executed financial system. Living reactively means putting an emergency expense on a high-interest card, which just creates instant anxiety. Instead, we're going to build an automated, defense-first system where your money moves exactly where it needs to go without you even having to think about it. The gap between those who build wealth on a middle-class income and those who don't, it isn't about intelligence. It's entirely about having a system that runs on autopilot.
So here is our blueprint for moving you from financial defense to long-term offense. We're going to cover the middle-class financial reality, automating achievable savings goals, building a high-yield CD ladder, navigating 2026 retirement account limits, and finally, shielding your wealth with an HSA.
Section 1. The middle-class financial reality, escaping the squeeze. Let's get right into it and look at what's actually happening at your dining room table.
Having zero financial buffer forces hardworking families into a vicious debt spiral over completely standard life events. An $838 transmission fix or a $400 to $650 insured trip to the ER, there shouldn't be financial catastrophes. But when your budget is tight and you have zero cash reserves, that 24% APR credit card suddenly becomes your only lifeline. You end up paying $15 or more a month in pure interest just to keep your head above water. We absolutely have to build a wall between you and that credit card.
Section 2. Automating achievable savings goals. Building the defense. Let's talk about building that realistic emergency fund. Instead of demanding impossible 20% savings rates right out of the gate, we're going to start small and increase quarterly. This way, your budget adjusts naturally over the course of 2026. If your target is to save up a solid buffer, starting with a massive monthly withdrawal is basically a recipe for failure. It'll feel way too restrictive and you'll probably abandon it by February, but starting with just $75 a month, that is totally manageable. Then, every 3 months, you give yourself a slight savings raise. By the fourth quarter, you're putting away $200 a month and you barely felt the squeeze because you eased your lifestyle into it.
Now, the crucial point here is to completely bypass your own willpower. Schedule these transfers to happen automatically, keeping the money out of sight and out of temptation. If you're relying on what's left over at the end of the month to fund your savings, I can promise you there will rarely be anything left. By moving the money the literal day after your paycheck hits your checking account, you artificially constrain your spending. You adapt to the lower balance, and your wealth just builds silently in the background.
Section 3. Building a high-yield CD ladder, the steady offense. Once your emergency cash is secure, it's time to capture some better returns.
Let's talk about the CD ladder. Staggering your maturity dates balances the high interest rates of long-term CDs with the flexibility of yearly cash access. When you buy a CD or a certificate of deposit, you're agreeing to leave your money with the bank for a set period in exchange for a higher guaranteed interest rate. But locking all your cash away for 5 years is kind of terrifying, right? What if you need it? Well, a ladder acts like a staircase for your money, and it solves this problem beautifully.
If you divide your capital into 5 parts, you'll eventually have a high-yield CD maturing every single year, which provides incredibly predictable liquidity. Let's say you have $5,000 to invest. Instead of dumping it all into one account, you put $1,000 into a 1-year CD, $1,000 into a 2-year, and so on, all the way up to a 5-year term. When year 1 finishes, you take that matured money and reinvest it right at the top of the ladder into a brand new 5-year CD. Keep doing this, and soon you're earning the highest long-term interest rates available, but you still get access to a chunk of your cash every single year.
Following these guardrails ensures you maximize your yield without accidentally sacrificing your principal to bank penalty fees. The absolute kryptonite of a CD strategy is having an emergency and being forced to break your CD contract early. Banks will hit you with an early withdrawal penalty that can wipe out your earned interest and sometimes even eat into your original deposit. The latter strategy gives you those scheduled exit ramps so you never have to break the glass early. And of course, always make sure your chosen bank is FDIC insured, keeping your money legally protected up to $250,000.
Section 4. Navigating 2026 Retirement Account Limits, Long-Term Growth. Let's look at the updated rules for building generational stability. $7,500. This is your 2026 contribution limit for an IRA or Roth IRA. And capturing this is a massive step in future-proofing your family's wealth. And hey, if you're 50 or older, you get a special bonus, an extra $1,100 catch-up contribution to help you accelerate as you approach retirement. Automating a small percentage of your paycheck into these accounts, heavily utilizing low-cost index funds, and letting compound interest do the heavy lifting over decades, that is literally the most proven wealth-building formula in existence. However, if you have a workplace retirement plan like a 401k, you need to watch out for income phase-outs that impact your ability to deduct traditional IRA contributions. For 2026, if you're single and earning between $81,000 and $91,000, or married filing jointly earning between $129,000 and $149,000, the tax deduction you get for a traditional IRA slowly phases out to zero. Why does this matter? Well, you need to know these limits so you don't bank on a tax break you won't actually get. If you fall into these ranges, a Roth IRA, where you pay taxes now but the money grows tax-free forever, might just become your best friend.
Section 5. Shielding wealth with an HSA, the stealth tool. Finally, let's talk about special teams, guarding against the inevitably high cost of future medical care. An HSA isn't just an account for your current copays. When used strategically, a health savings account acts as an incredible stealth wealth-building tool that grows tax-free for decades. Most people just think of an HSA as a checking account for the pharmacy, but honestly, that is a massive missed opportunity. An HSA offers a triple tax advantage. Your contributions lower your taxable income today, the money grows tax-free if you invest it, and withdrawals are completely tax-free if used for qualified medical expenses. Literally no other account does all three. By maximizing the exact 2026 limits, which are $4,400 for individuals and $8,750 for families, you create a dedicated fortress of cash. This covers your family's health needs without ever derailing your primary retirement funds. Also, notice that if you're 55 or older, you can throw in an extra $1,000 catch-up contribution. If you can afford to pay your current medical bills out of pocket and actually invest the money inside your HSA, you are building an untouchable medical nest egg for your retirement years, right when healthcare costs naturally peak. Since just hearing about these tools won't change your family's future on its own, my final challenge to you as your coach is to pick just one strategy and automate it today. We've covered the defensive emergency fund, the steady CD ladder, the 2026 IRA limits, and the stealth HSA. Don't try to do them all at once. Pick the one that makes the most sense for your household right now. Log into your bank, set up an automatic transfer for the day after payday, and let the system do the heavy lifting for you. So which one will you choose? I'll see you in the next explainer.